Stop thinking that paying off your mortgage means you actually own your home. In California, a quiet revolution in property tax law is turning homeowners into tenants of the state, and the eviction notice arrives once a year in a white envelope. You paid off your home, you did everything right. You followed the classic American playbook: work hard, save money, pay down the debt, and secure your retirement. You believed that once the bank was out of the picture, at least one part of your life would finally feel stable. But lately, that sense of control has been slipping away. People are saying it plainly in coffee shops and online forums. Paying property taxes now feels like paying rent. Others ask a question that sounds half joking, but is actually terrifying. If I stop paying property taxes, can I really still call this my home? And before you know it, you realize you have been asking yourself the same thing. What is bothering people isn't just the number on the bill. It is the feeling that the rules keep changing. There was a time when you knew what you owed and why. Now, every year brings another adjustment, another reassessment, another requirement no one clearly explained. For retirees living on fixed incomes, those surprises don't just cause stress. They quietly shake the sense of security people thought they had earned. So, what has actually changed? Who is being hit the hardest? And why are so many Californians growing angry? In this deep dive, we are going to look at the specific mechanisms, Prop 19, reassessments, and hidden bonds that are reshaping the California dream. If you want to protect your wallet from the government's reach and stay ahead of these tax changes, make sure you subscribe to Tax Hack Pro right now. We track the laws so you don't become a victim of them. Let's take a closer look. Number 1, expanded property value reassessment. What shocks a lot of Californians isn't some sudden, dramatic tax hike that makes the evening news. It is something quieter, something more insidious. You didn't sell your house. You didn't remodel it. You didn't add a pool or build an ADU. You just kept living there the same way you have for years, maybe even decades. And yet, every year, your property tax bill shows up a little higher. Not enough to cause immediate bankruptcy, but enough to make you stop, look twice, and think, wait, why did this go up? This is the direct result of property values being reassessed more closely to today's market prices, often triggered by minor events or local bond measures. Put simply, the state isn't just looking at what you paid for your home in 1990 anymore. It is looking at what the tech worker next door just paid for the house down the street. When those prices go up, the value used to calculate your taxes moves up too, dragging you along for the ride. On paper, the government says this is reasonable. If property values rise, the tax base adjusts. Local governments need funding for schools, fire departments, police, roads, and basic services. No politician comes out and says, "We're raising your taxes." It happens quietly, spread out over time through reassessments that feel technical and distant. But the people living in those homes don't experience it as a technical change. They experience it as pressure. Many longtime homeowners in California bought their homes back in the 80s or 90s. They didn't buy them as speculative investments to flip. They bought them to raise families, build a life, and eventually retire in place. When they planned for retirement, they believed that once the mortgage was paid off, the biggest expense was behind them. Taxes might rise a little, capped by Prop 13, but nothing unmanageable. What they didn't plan for was the housing market exploding around them and dragging their peripheral costs along with it, while their income stayed the same. You see this frustration clearly in the comments on our channel. People say things like, "Nothing about my house changed, but my taxes did," or "I didn't get richer, but my tax bill says I did." These aren't complaints from speculators or house flippers. They are coming from retirees, widows, and couples in their 70s who stayed put and assumed that stability would be rewarded, not penalized. For people still working, a few hundred or even a few thousand more a year might be annoying but survivable. For retirees living on Social Security or a fixed pension, it is a completely different calculation. A higher tax bill means cutting somewhere else, fewer prescriptions, delayed doctor visits, postponed home repairs, even when they know those repairs will cost more later. What really gets under people's skin isn't just the money, it is the loss of control. Homeowners don't decide when their neighborhood becomes hot. They don't control when Apple or Google opens an office nearby. And unless they sell, they don't actually benefit from those higher values. Their wealth exists on paper, while their bills arrive in real-life cash. The system treats them as if they are richer, even though nothing about their monthly reality has improved. From the government's point of view, the argument is straightforward. Rising property values create pressure to maintain funding for public services. Without that revenue, schools struggle, emergency response slows, and infrastructure falls behind. And to be fair, that concern isn't imaginary. But the problem is that the system doesn't distinguish between people who can afford those increases and people who can't. It looks at property values, not at the lives being lived inside those properties. That is why many homeowners now open their tax notices with a knot in their stomach. Not because they expect to lose their home tomorrow, but because they don't know where this ends. Will it level off? Will next year be worse? What happens if home prices spike again? This kind of pressure doesn't force anyone out overnight. There is no eviction notice, no dramatic deadline. Instead, it wears people down slowly, year after year. And for many longtime Californians, the fear isn't an immediate disaster. It is the realization that staying in the home they plan to age in is becoming harder than they ever expected. Number 2. Limits on inherited property tax protections. Prop 19. If one day you are no longer here, what will your home leave behind for your children? A safe place to live, a financial cushion, or a property tax bill so high that they are forced to sell right away. For decades, many families in California never really questioned this. They believed inheriting a home was a natural continuation. Parents worked hard, paid off the house, and passed it down. Their children could keep it, rent it out, or at least have time to figure out their next move. That belief was a cornerstone of the middle-class sense of stability in California. It was the promise of generational wealth. But recent changes in tax policy, specifically Proposition 19, have made that belief far less certain. Under the newer rules, inheriting a home no longer automatically means keeping the low property tax base your parents paid. In many cases, once ownership transfers to the next generation, the home is reassessed based on current market value unless very specific conditions are met. That means the same house on the same street can suddenly come with a completely different tax burden simply because the name on the title changed. Technically speaking, this isn't a public tax increase. It is a narrowing of long-standing protections. But for families, the impact is immediate and visceral. A home that once came with a manageable tax bill of $2,000 a year can quickly turn into a financial strain costing $20,000 a year, an expense the next generation never planned for. Plans to hold on to the house, rent it out for passive income, or wait for the right moment to sell can collapse overnight because of a new number on a tax bill. What makes this change especially painful is when it happens. Inheritance rarely comes at a calm, organized moment. It usually happens during grief, when families are dealing with loss, funerals, legal paperwork, and emotions that haven't settled yet. Facing a complex tax system and a sharply higher tax bill in that moment leaves many people feeling overwhelmed, even pressured to make decisions faster than they are ready for. That is when the hard questions start to surface. Is keeping this home even realistic anymore, or will the taxes alone become unmanageable year after year? If we rent it out, will the rent actually cover the new taxes, insurance, and maintenance? And if we sell, are we letting go of something our parents spent their entire lives trying to protect simply because the rules have changed? From the perspective of California's government, the reasoning behind this shift is fairly straightforward. For years, some inherited homes continued to benefit from very low tax assessments, even when they were used as rental properties or vacation homes by heirs who lived elsewhere. As home prices rose sharply, the gap between taxes paid and actual property values grew wider. Lawmakers argued that the system no longer reflected reality and needed to be adjusted to help fund public services. On paper, that logic holds together. But in practice, the law doesn't distinguish between everyday families and massive corporate investors. It applies the same calculation across the board, regardless of where heirs live, how much they earn, or how deep their emotional ties to the home may be. That one-size-fits-all approach leaves many families caught off guard and unprepared. As a result, some families lose the ability to keep a home, not because they mismanaged money, but because a policy change arrived without enough warning or time to plan. This taps into a deeper anxiety many Californians are now feeling. Is a home still something you can truly pass down to the next generation, or has it become a temporary asset tied to increasingly fragile conditions? That is why the reaction hasn't faded into a brief moment of anger. It has turned into ongoing unease. More and more people are quietly asking themselves the same question when they think about their family's future. If even passing a home to your children is no longer certain, what exactly are we trying to hold on to? Number 3. Conditional tax-based transfer for homeowners over 55. If you are over 55, you have probably heard there is a rule that is supposed to help you move without getting crushed by higher property taxes. On the surface, it sounds like a lifeline. You sell your old home, buy a new one, and bring your lower tax base with you. Simple enough. But the part most people don't realize is that this protection only works if everything is done exactly right. Under the current rules, also part of Prop 19, homeowners over 55 may be allowed to transfer their existing property tax base to a replacement home. That means the tax level you had on your old house can follow you to the new one instead of resetting to today's market value. For many seniors, this provision was designed to make downsizing possible and to free up housing inventory without punishing people who need to move for health, family, or safety reasons. The catch is that this transfer is conditional. There are timing requirements. You generally have 2 years. There are filing requirements. There are value limits. The new home shouldn't drastically exceed the sale price of the old one. And there are county rules that don't always match up neatly. Miss a deadline, misunderstand a form, or assume something will happen automatically, and the protection can vanish. When that happens, the new home is taxed at full market value, often resulting in a much higher bill than expected. This is where frustration starts to build. Many homeowners assume the system will guide them, or that their realtor or escrow company will handle it. In reality, the responsibility often falls squarely on the homeowner to know the rule, request the transfer, and submit everything correctly. For someone already dealing with the stress of selling a long-time home and adjusting to a new stage of life, that is a lot to ask. From the state's perspective, the conditions are meant to prevent abuse and keep the program targeted. Lawmakers want to help seniors move when they need to without turning the transfer into a blanket loophole for the wealthy. That reasoning exists, and it is part of why the rule is structured the way it is. But in practice, the complexity creates risk. Seniors who move closer to family, into a smaller home, or into a safer neighborhood can find themselves punished for a paperwork mistake. The result is that many people
나를 불러주는데 내가 약간
decide
좀
not to move at
이렇게
all. They
소외될
stay in
때도 있고
homes
어느
that are
해는
too big,
그치,
too
맞아. 또
expensive,
계속 내가 주류가 아니니까
or no longer
사무실에서
suitable for their health simply because the tax
올해는 좀
risk
주류가
is
아닌
too
것 같아.
high. And that is the deeper issue. A rule meant to offer flexibility ends up creating fear. Instead of feeling empowered, homeowners worry that one wrong step could permanently raise their taxes. They are forced to ask a hard question. Is moving worth the risk? This isn't just about taxes. It is about mobility, independence, and the ability to make decisions later in life without financial landmines. When even a move meant to simplify life comes with this much uncertainty, people stop feeling protected and start feeling trapped. Number 4, reassessment of small residential rental properties. What if the small rental you rely on for a retirement income suddenly stops making sense financially? Not because tenants left, not because you raised the rent too much, but because the tax bill quietly climbed to a point where the math no longer works. For many Californians, especially older homeowners, owning one small rental property was never about becoming a landlord tycoon. It was a safety net. It was a way to supplement Social Security, a backup plan in case medical costs rose or savings ran thin. Often, it was the former family home or a modest second property held onto for stability, not speculation. But as property values have risen across much of California, small residential rentals have increasingly been pulled into reassessment cycles that push taxable values closer to current market prices. On paper, the property looks more valuable. In reality, the income it produces hasn't kept pace. Rents can only rise so much before tenants push back, move out, or fall behind due to rent control laws. Taxes, on the other hand, don't negotiate. This is where the pressure builds. A higher assessment means higher property taxes, higher insurance costs, and often higher maintenance expenses at the same time. For large corporate investors with multiple properties, those increases can be absorbed, spread out, or written off. For someone with one rental, especially a retiree, there is no cushion. One unexpected jump can turn a modest income stream into a monthly loss. As a result, many small landlords face a hard choice: raise the rent and risk losing reliable tenants, or violating rent control. Hold rent steady and absorb higher costs, or sell the property altogether. And when enough people choose to sell, something else happens quietly. The supply of small, relatively affordable rentals shrinks, often bought by large corporations or owner-occupiers. That is why this issue resonates beyond property owners themselves. It affects tenants, neighborhoods, and housing stability overall. What starts as a reassessment on paper can ripple outward into fewer rental options and more financial strain on both sides of the lease. Number 5, mandatory compliance requirements for inheritance filings. What if losing your family home had nothing to do with money problems and everything to do with a missed form or a filing deadline you didn't even know existed? For many California families, that is no longer a hypothetical question. It is a risk hiding in the paperwork. When a home is inherited, keeping certain tax protections now depends heavily on strict compliance requirements. That means specific forms, like the claim for reassessment exclusion for transfer between parent and child, must be filed, deadlines must be met, usually within 3 years or before transfer to a third party, and documentation must be completed exactly as required. Miss one step, file late, or misunderstand a requirement, and the property can be reassessed at full market value. Once that happens, there is often no easy way back. On paper, this system is about order and accountability. Tax authorities need clear records to determine eligibility for protections. Deadlines exist to prevent abuse and ensure consistency. From an administrative standpoint, that logic holds. The rules are written down. The process exists. In theory, anyone can follow it. In real life, though, inheritance rarely unfolds in a calm, organized way. It happens during moments of loss, grief, and confusion. Families are juggling funeral arrangements, legal documents, estate matters, and emotional strain all at once. In that environment, it is easy to overlook a notice in the mail or assume a form will be handled automatically by a trust lawyer or executor. That is where the system becomes unforgiving. The tax code doesn't pause for grief. It doesn't adjust for confusion. If a required filing isn't completed on time, protections can disappear permanently. Families often don't realize what went wrong until a new tax bill arrives, showing a number they never expected and can't afford. What makes this especially painful is that the mistake isn't about intent. These aren't families trying to dodge taxes. They are families who didn't know a deadline existed, didn't understand how strict the requirements were, or assumed the process was simpler than it actually is. The penalty for that misunderstanding can be life-changing, but for ordinary Californians, the result feels harsh. A home that could have stayed in the family becomes a financial burden overnight. Not because circumstances changed, but because paperwork did. The question people start asking isn't just, what did we miss? It is, why is the margin for error so small when the stakes are this high? And that is the deeper impact of these compliance rules. They turn inheritance into a high-risk moment where one administrative slip can override decades of careful planning. Number 6. Increased reliance on local assessments and special charges. The surprise rarely comes from the main tax rate. It comes when homeowners slow down and actually read the full bill. The base property tax is there, just as expected, usually around 1%. But underneath it, line after line starts to appear. School bonds, fire protection fees, infrastructure assessments, special districts tied to services most people barely notice day-to-day. Mello-Roos. None of these charges look alarming on their own. $50 here, $100 there. But together, they quietly change what it costs to stay in your home. What makes these charges so easy to overlook is the way they arrive. They don't show up as one big increase. They are approved locally, added one at a time. Often framed as targeted fixes for very specific problems. Better roads, stronger emergency services, safer communities. Each measure sounds reasonable. Each dollar amount feels small enough not to fight. Over time, though, those small amounts stack up, and the total bill begins to drift far beyond what homeowners originally planned for. Many people notice that even when the core property tax stays relatively stable, the final number keeps rising. It isn't dramatic. There is no single moment that explains it. One year, it is a new assessment for schools. A few years later, a district fee for fire protection. Slowly, the bill becomes something different from what it was when they built their budget around it. The deeper frustration is that these charges don't feel like choices. Homeowners can't opt out. You can't switch districts or decline a service you don't use. The fees are attached to the property itself, not to how often you benefit from them. Once they are in place, they become part of the permanent cost of ownership. Local governments turn to these assessments because they are effective. They allow communities to raise money without increasing headline tax rates, and they spread the burden across neighborhoods. From a policy standpoint, the system functions as intended, but from the homeowner's perspective, the experience feels very different. The costs rise without a clear point of consent, and the pressure builds without a single decision to point to. Over time, that quiet accumulation changes behavior. People stop opening their tax bills casually. They start looking for where the next increase might come from. And even if each charge makes sense on its own, the combined effect reshapes the feeling of stability that long-term homeownership was supposed to provide. Number 7. Reduce tax stability for fixed-income homeowners. What happens when your income stays the same, but the bills around you don't? For many fixed-income homeowners in California, that question is no longer theoretical. It is something they feel every year when the property tax notice arrives. For people living on Social Security, pensions, or a combination of both, stability is everything. The numbers are tight but predictable. You know roughly what comes in and what goes out. That predictability is what makes staying in your home possible. The problem is that property taxes are becoming less predictable at the exact moment when flexibility is gone. Even modest increases can throw the balance off. A few $100s more might not sound dramatic to a working professional, but on a fixed income, it has to come from somewhere. There is no overtime to work, no raise to negotiate, so homeowners start making quiet adjustments. They delay medical appointments, they skip repairs, they cut back on groceries and essentials, telling themselves it is temporary even when it isn't. What makes this especially unsettling is that the increases don't feel tied to personal circumstances. Taxes rise because values rise, assessments change, or local charges are added, not because the homeowner's ability to pay has improved. On paper, the house looks more valuable. In real life, nothing about the household budget has changed for the better. Over time, that gap erodes confidence. Homeownership was supposed to bring certainty in retirement, not new anxiety. Instead of feeling protected by years of planning and paying off a mortgage, fixed-income homeowners feel exposed to forces they can't control and can't offset. Number 8. Gradual displacement of long-term residents. What is making Californians angry isn't that they are being forced out of their homes overnight. It is that the new property tax laws are slowly pushing them out in ways that are easy to miss until it is too late. There is no eviction notice, no single law says you have to leave. Instead, it is a chain reaction. Higher reassessments, weaker inheritance protections, complicated tax-based transfers, added local charges, and tax bills that become harder and harder to predict for people on fixed incomes. Each change on its own might be manageable. Together, they make staying put increasingly unrealistic. People aren't leaving California just because they want to. They are leaving because the math no longer works. Not because they made bad choices, but because the rules changed while their income didn't. Longtime residents who have lived here for 20, 30, even 40 years are starting to realize that loyalty to a place no longer buys stability. From the outside, this can look like normal market turnover. Homes sell, new owners move in. But from the inside, it feels like being pushed out, not by choice but by policy. And that is where the anger comes from. Not one single law, but the combined effect of changes that leave people feeling like California is becoming a place where they are no longer allowed to grow old in their own homes. These changes don't hit all at once, and that is exactly why so many people miss them until the pressure is already there. California's property tax laws aren't just numbers on a bill anymore. They are quietly reshaping who gets to stay, who gets pushed to the edge, and who is forced to leave without ever being told outright. If this breakdown helped you see the full picture behind what is really changing, take a moment to like this video and subscribe to Tax Hack Pro. We are here to help you stay informed, ask the right questions, and protect your future before the rules shift again. Thanks for watching, and we will see you in the next one.